impact of all of this, and starting off with the European Union offering once again to help out Ukraine with its finances.
Indeed, that is first up in this bulletin. The European Union is stepping in to help Ukraine's new leaders shore up their battered economy. Overall, the European Commission says the EU is ready to provide Ukraine with 11 billion euros. The aid package would consist of both loans and grants. Joe Tandy breaks down the figures for us now, and he looks at how far the money will go.
A day after the US proposed a billion-dollar aid package, European Commission President Jose Manuel Barroso took his turn to play the herald of good news for Ukraine's economy.
The package combined could bring an overall support of at least 11 billion euros over the next couple of years.
Of the 11 billion euros on the table, 3 billion will come from the EU Commission itself, 5 billion from the European Bank for Reconstruction and Development, and 3 billion more from the European Investment Bank. Of the 3 billion euros coming directly from the EU Commission's purse, 1.6 billion takes the shape of loans, with the remaining 1.4 billion coming as grants. The EU plans to spread the money over the period up to 2020, meaning only a small part of the package is for immediate use. The Ukrainian government said it needs more than 25 billion euros over the next 2 years to avoid bankruptcy. Beyond direct support for the Ukrainian national budget, the EU money will help pay for infrastructure projects like reforming the gas transit system, plus judicial and political reform. European leaders meet in Brussels on Thursday to sign off on the deal. Even then, the EU will need the green light from the International Monetary Fund before handing over large parts of the cash.
And taking a look at another angle of this story, Russia burned through $11.3 billion to defend the ruble on Monday. That's according to the Russian central bank. It stepped in to buy rubles to prevent the currency from falling further. There was panic selling, as you may remember, as investors left the Russian currency on the news of Russia's intervention in Ukraine. The daily spend was 5 times higher than the previous daily record from 2011. Now, we talked about the European Commission a few moments ago. It's had a busy day, let's just say that, because the European Commission is also placing France and its spending habits under close surveillance. It comes as the Commission says that France will fail to bring its budget deficit down to agreed levels. It stresses the need for decisive action. Otherwise, the Commission says France's finances could weigh on the wider Eurozone economy. And if we stay with the Eurozone, the private sector in the 18 countries that use the single currency is growing at its fastest pace in 2.5 years. That's according to research firm Market and its Purchasing Managers Index for February. Both the manufacturing and services sectors are seen expanding, and it's seen as a fresh sign that the Eurozone is pulling away from the crisis. France is the only laggard, though. It's the only country to report a contraction in business activity. And from Europe, we're going to head to China next. Its government has pledged to continue along the path of economic reforms. Premier Li Keqiang spoke at the National People's Congress earlier. He said China will open up state-dominated industries to private companies and make banks more market-oriented. This, as he also set out a growth target of 7.5% this year. Kate Moody has more.
A modest growth target for the world's second-largest economy. Chinese officials said they expected growth to remain around 7.5% in 2014. That's the same as last year's target and slightly lower than the 7.7% actual growth rate in 2013.
This target is in keeping with our goal of finishing to build a moderately prosperous society in all respects. It will boost market confidence and promote economic structural adjustments.
China's growth used to consistently outstrip official targets as the government maintained a tight grip on the economy. But the last 5 years have seen a slowdown in the once blistering economic growth as the Communist Party turns its attention to reforms. That includes allowing the Chinese currency, the yuan, to float more freely on the markets and making the country more business-friendly for foreign firms. Officials also hope to continue the shift from an export-driven economy to one based more on domestic demand. But analysts warn that as the government tries to reduce its public capital spending, the private sector may not be strong enough to keep the economy on track. Recent manufacturing data indicates factory activity is slowing down. If that continues, overall growth could weaken and shrink below the 7.5% target.
We're going to take a look at how the stock markets are faring finally. Investors, they're still keeping an eye on the Ukraine situation after a volatile week so far. This session, the American indices are quite steady, at least in comparison to the gains that we saw yesterday and the massive falls that we saw on Monday. The Dow Jones Industrial Average is down around about 0.25%, whereas the Nasdaq and the S&P 500 are fairly flat. It also comes on fresh signs that harsh winter weather has slowed the US economy. We're going to take a look at that story in just a moment. In Europe at the close, the markets, they were in negative territory, at least the main markets. It follows strong gains on Tuesday. The DAX down 0.5% and the FTSE 100 in London down 0.7%. Let's just return to that story I was talking about in the United States a little earlier. Hiring by the private sector in the United States was weaker than expected in February. Payrolls company ADP says that private businesses added 139,000 jobs during that month. The reading missed expectations of 150,000 new jobs. Analysts say it's a sign that February was a weak month as unusually cold weather put a dampener on businesses and hiring. We've basically heard this kind of language in the past few weeks or so, that cold and wintry weather put a dampener on the US economy. We've even heard so from the US Federal Reserve and its chief, Janet Yellen. That's the business news for now. It's back to you, Laura, for the rest of it.
Thank you, Marcus. And we'll see Marcus again in an hour for another business update. Let's bring you up to date with what's been going on in the world of sport, though. Dan Levy is here with